Good afternoon, everybody. As you can see, the sun is shining where I am, and good evening for those of you where the time zone is a little later. Pleased to be joining you today, and I'm pleased to be talking about the state of SaaS, really from an LP perspective. I'm going to share some slides. So it's well known that software is eating the world. The question from an investor's perspective is how much more of the world does it have left to eat? Is the upside still there in the future? So what's the LP opportunity in SaaS today? A little bit about myself, first of all. I've been investing as a venture investor since the mid-90s and in SaaS companies for 18 plus years, since the time when they were called ASPs. A number of companies are listed here that are in that have exited. In the case of Forescout, went public on NASDAQ and then got acquired more recently by private equity from the NASDAQ market. Most of the companies in which I've invested are based in Europe, in various places, or in Israel. I co-founded Ox in 2017. I am a general partner there. Ox is a firm that's based in London and Stockholm and investing in scale-up stage SaaS companies around Europe. In my past, I've chaired the British Venture Capital Association. I'm currently the vice chair and past chairman of the Tel Aviv University Trust. So SaaS, as is well known in these COVID days, has performed very well in the public markets. SaaS enterprise values have pulled away from other asset classes, and the cloud index, the Bessemer Venture Partners Cloud Index, is the dark line at the top here on the chart on the left, has really outperformed. And the spread above NASDAQ growth since 2017 is now 2 times what it was. Cloud company IPOs have raised more than twice as much capital in 2019 as they did in 2020 year to date as they did in 2019. Good examples of that would be Snowflake, Unity here from Europe, a number of other players that are well known. And public SaaS leaders like Salesforce, Zoom, DocuSign have added more than 50% on average to their current market cap in the past 9 months. So markets for SaaS companies in particular are very, very high. But this is confusing because actually revenue expectations have decreased. If you look on the left, these are the forecast ARR growth for the cohort. 2020, before COVID, growth in ARR was forecast to be 39%. It's now forecast to be half of that, with a particular hit to new bookings. It's hard to attract new customers in these COVID times. Churn is up, and actually the blended CAC ratio is up as well. So the metrics aren't as strong, the forecasts aren't as strong. And actually spend forecasts are showing a blip. So on the right here, you have SaaS spend forecasts for SaaS revenues worldwide, and they're holding steady, maybe slightly increasing this year at just over $100 billion. So with these factors taking place, what is it that's driving the valuation change? Well, here's our thesis. For any startup, and this is certainly true in SaaS, crossing the chasm has been the historical challenge. You could get early adopters, particularly in the first vertical that you're targeting, but it was very tough to move across to the early majority. The early majority would ask questions like, how do I know the proven benefit of using this? And it was hard to prove the benefit. There was a lot of risk. So even though a SaaS product is probably better, almost certainly better than the alternatives, that's only half the battle. Educating customers such that they're willing to take product risk is the biggest challenge. But now the chasm isn't really there anymore. what's happened is that the market expectation for the rate of digital transformation, and this really works across the global economy, has changed fundamentally. The early majority are no longer asking those kind of questions. Product risk has essentially disappeared, and enterprises of all types have suddenly moved up the adoption curve in buying intent because they have to in the environment in which we live. So we believe that the valuation change is explained by latent demand and post-COVID revenue expectations having increased dramatically. A number of leaders in the industry are saying that digital transformation isn't an option anymore, it's a requirement. It's well known that Satya Nadella from Microsoft said, we've seen 2 years worth of digital transformation in 2 months. Mark Benioff from Salesforce and Sundar Pichai from Google have seen exactly the same things from their customers and in the digital transformation that those customers are going through. SaaS is going to own the new normal and thrive in the post-COVID environment. The reasons why everyone's betting on SaaS to win are that delivery matches demand, remote sales, remote delivery, remote implementation, remote upgrade, and fast time to value. Those fit very closely with the world that we're in today. Product-led growth, new products enabled by the cloud, subscription delivery model being something that the world is comfortable with, and it's becoming normal. And as a result, SaaS itself has crossed the chasm. All of us today have grown up on consumer SaaS. 10 years ago, cloud software was considered a risk in the enterprise. Now it's the norm. And that leaves us with the question, well, how much further does SaaS have to go? Actually, it's very interesting to note that although in groups like this, we're very used to SaaS penetration, it's actually still early. Cloud penetration in the enterprise is still early. So if you look at the columns here today, the 2020 forecast figure, actually the public cloud and the private cloud together are still only just over half of cloud penetration in the enterprise. You still have traditional data centers with nearly 50% of enterprise usage. And we think that overall, the $100 billion or so of SaaS revenue today is going to increase substantially as industries like education and healthcare evolve and digital transformation in those industries starts to accelerate. The global software market today is about $650 billion. We think that the $100 billion of SaaS will penetrate much further into that. And we think the $650 billion itself is going to grow substantially. Very interestingly, from an LP perspective, in Europe, SaaS funding lags way behind the US, despite very similar demographics. We think this speaks to opportunity. Our population in Europe is about 1/3 larger than the US. Our GDP is approximately the same as the US. But SaaS, meanwhile, raises only about 30% of the amount of capital that's been raised in the US year to date in 2020. So it looks like it looks like an underserved market. I'd now like to introduce 2 panelists, Dominic Maier and Agata Zalubska. Dominic is from AXA Venture Partners and Agata from PFR Ventures. I hope that they'll be on the line right now, and I'll ask them to introduce themselves before I open this up for a panel discussion. Dominic, hi. Please go ahead and introduce yourself.
Sure, I'll be brief. Dominic Maier, head up venture fund investing at AXA. We have a global investment remit where we try to back venture managers across established venture ecosystems, ranging from seed to later stage.
Fabulous. Thank you, Dominic. Agata.
Good evening, everyone. My name is Agata Zalubska, and I work at PFR Ventures, which is the part of Polish Development Fund. We are based in Warsaw, and as a public LP, our main mission is to support our local ecosystem through selecting the best local and also international fund managers that could bring value to our market. And we also opened last year a private equity arm within our organization.
Thank you both. Great to have you with us here today. So I'm going to start with the first question. There are lots of different investment strategies within SaaS. How do LPs consider allocation to these different strategies? And perhaps in particular, what portfolio company lifecycle development stage is most attractive from an LP perspective? Dominic, maybe we could start with you on that one, please.
Sure. I think within SaaS, it pays off to play at a stage where you're coming in before the later stage investors. I think at that stage, the cat is out of the bag, so to speak, and people understand whether or not a company has, the potential to be something large, and valuations start creeping up, and that puts potentially a limit on kind of any attractive risk-adjusted returns that are going to come out of that company. And therefore, as an LP, what we tend to look for is strong potential from a fund level to make returns, and therefore coming in at an earlier stage where the manager shows the ability to gain conviction and to get sufficient ownership to be able to drive strong fund level returns. We kind of over-index on that particular element. And I think, depending on where in the world this is, again, we look at this from a global lens, that could be significantly earlier in the US than it is in Europe, partly because of the availability of capital and the comfort of GPs to take risk from the perspective of a revenue maturity. That's kind of how we adjust our portfolio when it comes to investing across both of those markets.
Mm-hmm. Agata, how do you think about this?
Yeah, we have a bit different perspective because we look on the managers from the perspective of more local LP, right? And our market is still growing, and that's why we concentrate more on early stage of the development. So we allocate more funds into now pre-seed and seed stage, and these are more local VC, but we also dedicate a part of our strategy to more growth capital where we expect higher returns. So we try, to have balance because our market is still in this development phase.
Okay, that's interesting. So I guess Poland, where you're based and where you operate, is a non-traditional geography in Europe. It's not like the traditional hubs like London, Stockholm, Helsinki, Paris, Berlin. It's non-traditional hubs have produced UiPath, for example, from Romania. How do you think about Poland specifically and the opportunity in SaaS for non-traditional, more frontier geographies generally?
Yes, exactly. Poland represents a non-traditional geography for sure. And what we have here is talent. And I would say that there is a lot of talent tech talent in the CE region. And the success of UiPath has somehow paved the way for many international funds to look for deals in the Central Eastern Europe. And what we observe is that these non-traditional geographies are more often present in the fund strategies. And I think this could be with benefit for both local managers, local markets, and managers who will have more diversified portfolio. And additionally, from the returns perspective, still GPs can benefit from lower valuations that we have here. But of course, there is still a lot of work to do. We need to learn how to commercialize, how to scale SaaS companies. But of course, we don't have, as Poland, we don't have a pure unicorn still, but we are waiting for it.
Working on it, I'm sure.
Yeah.
Dominic, how do you think about that dimension of allocation strategy? It's orthogonal, or is it, to the stage description that you were thinking about, specifically as you're not tied to Europe or any individual continent. Indeed, you're not tied to any stage. How do you think about these non-traditional geographies in Europe?
So first of all, I think it certainly is an exciting time to be an entrepreneur in a non-traditional geography. I think what's been proven out over the last half a decade for sure, and over the last 6 months definitely, has been the fact that Silicon Valley is more of a mindset than a physical location. And I think that's playing out everywhere. So it's leveling the playing field. In terms of our own allocation, the way we think about that is, relying on the venture ecosystem to do what it does best, to have local pre-seed and seed funds plant a lot of seeds, see which ones of those work, see which ones of those have ideas which are great from the perspective of the timing of the market and are able to drive interesting financial metrics, for then a more regional Series A firm to pick up that subsequent round, and then a even more pan-regional Series B firm to do so above that. And what we're counting on, until some of these non-traditional ecosystems become large enough for us to allocate seed capital to, is for our Series A or perhaps Series B managers to pick up some of the best firms coming out of those geographies in order for us to benefit from those in our portfolio.
Thank you. And then taking that forward, SaaS companies still need to succeed in the US to be able to generate the best exits. That's still sort of pretty clearly the case. How would you say that LPs would compare US GPs who are well used to doing that with later stage SaaS companies? We all know some of the names like GA, General Atlantic, Insight Partners, people like that, with indigenous, local and pan-European GPs, as you were referring to just now. How do you think about the interplay between those as an LP?
I think it's Europe's biggest challenge, I would argue, is to make sure that public market institutions become more comfortable backing IPOs coming out of venture-backed businesses, particularly within enterprise software and SaaS. Frankly, for us, many European GPs are at a disadvantage because of that, in terms of there being potentially limited exit scope if those companies don't go over to the US. But again, I would go back to the kind of traditional venture model, where the companies that do have a breakout product, that do have a breakout potential, and let's use an example we've already mentioned here, UiPath. They very quickly raised capital from London, and then shortly thereafter from the US. And their headquarters now sits within New York, and they are a business that ultimately will exit in the US. And I wouldn't be surprised that once they publish their S1, we'll see that the majority of their revenue comes from the US as well, given the fact that corporates in the US are much more comfortable moving to cloud and buying SaaS solutions. So, it means that the best opportunities in Europe do bubble up and go over to the US. I do wish very strongly and have a strong desire to make sure that, or to at least allow the next best 10% in Europe to succeed by listing, let's say, in London, Amsterdam, Paris, wherever that might be, and not having to rely on US institutions for their IPO or their reverse merger via SPAC or their direct listing.
Thank you. Agata, PFR was set up pretty recently. How did you think about the exit opportunity for your underlying investments as you did that?
Yes, we are a pretty young company. We operate around 4 years right now. And what we see is that all top Polish SaaS companies go global, actually. So we see Booksy in the US, we see Codility in the US, Brand24, and so on, right? So what we are looking for from the LP perspective is we are looking for managers who will have ability to scale companies to the US, right? So we look for managers who will have their venture partners who could do deals with the US funds, right? So we look for this unique combination of skills and network. This is from the perspective of pretty much young LP, right?
Okay. So moving from the underlying companies and the way that they're managed to your choice of manager, as you look at the SaaS world, we obviously have a lot of SaaS specialist venture firms, GPs. How do you assess them? To what extent? And I'll start, Agata, with you. Is specialist knowledge required for LPs to be able to distinguish SaaS GPs from one another?
I think that specialist knowledge within the organization is always necessary to some extent, right? So during the due diligence process, we look also, we do deal attribution analysis. We look into the portfolio companies. So it's always necessary, you know, to know how to assess them, to look for the key metrics and KPIs. But I think the most important from our perspective is actually the relationships, right? We always ask a couple of difficult questions. So why are you doing this? What is unique within your strategy? And I think that the LP business is based on relationships, and this is what we are looking for in the long term, right? So specialist knowledge is always necessary, but I think this soft skills and maybe strong expertise on one sector, this is what we are looking for.
Okay. Dominic, you've been assessing fund managers for many years. How, as you've built up more and more knowledge of the space, how much specialist knowledge is required to do your job in assessing SaaS managers?
I think let's say if we rewind back to the venture industry, certainly in the late 90s, but even in the early 2000s, it was very opaque. You know, most managers didn't have websites. You couldn't almost figure out who worked there. It was very intransparent in terms of how companies were being assessed, what diligence was being done, things that were being looked for. Very difficult to get to. I think that's very different today in the venture world, both in terms of what companies need to show and also the types of things venture GPs look at when assessing companies. I think that transparency hasn't come to the LP world yet. And I think it's a long way away from coming to the LP world. And so there is, some level of necessity to have an apprenticeship model to understand how to make assessments around venture managers and how to spot, historical success that is replicable in the future. And so I think, the way I would say that it has to, or that, many people, I would say, in the industry do that is by kissing many frogs, and the ones you did kiss and didn't think would turn into a prince, but did, you learn from your mistakes, and the ones where you think they did and they have, you can try to use some pattern recognition to keep recognizing that going forward.
How does that help, if I can say, LPs who don't have that experience but want exposure to the asset class? How should they go about it? Because
so I think, yeah, I think the
lot of time. I mean, it's a long apprenticeship to get to the position that you're in.
No, I agree with that, and I think you know what Agata said, relationships that not only counts between LP and GP, but LP and LP. I think it's very important to understand, build strong, deep, long-standing relationships, and share notes, and try to understand what others are doing, where you're perhaps not seeing opportunities, and learning that way. I think there's no shortcut here, and it just takes craft.
Okay. I guess one of the other challenges that LPs face is, it's one of the key attractions of SaaS. It's capital efficiency, and SaaS is much more capital efficient than the other area in IT that takes a lot of investment money, which is B2C. How does that aspect of capital efficiency come into your thinking and affect your selection of GPs? Maybe Dominic, we could start with you on that.
Sure. Yeah, I think there's always a sensitivity around ownership, at least from our side, around initial checks and getting the ownership necessary in light of the fund size the check's coming out of. Within the SaaS world, there's, a little bit less pressure there to get to very high levels of ownership, because if something does work, the flywheel is efficient, and there's cash generation sooner rather than later, that dilution won't be orders of magnitude, right? Whereas if we're looking at a B2C play, you really need to start focusing on getting kind of ownership that starts with a 2, if you're coming in even at the Series A, because that's going to get diluted very quickly, because customer acquisition has been and continues to be very expensive on the consumer side. Okay.
Thank you. Agata, you're in an interesting position here, being in Poland, because of course Poland is a substantial economy and substantial population with its own language, has a strong defensibility and an adequate size, a good size for B2C businesses to be created. So you'll be investing in managers who are investing in a lot of B2C businesses that are addressing the local market. How do you think about the B2C area, and with its higher demand for capital, and the B2B area?
Yes, exactly. I agree with you, because we have a lot of VCs that invest in B2C, right? And when we see again the same strategy, right, or very similar one, we ask questions: what differentiates you, right? So we look for I would say unique strategies, and we see this shift from B2C more to B2B segment. And for instance, we have around 30% of our portfolio companies within our organization that are SaaS companies, right? So we still observe that the majority of our GPs are sector agnostic, I would say, and we are still building up our portfolio, but we definitely look for more specialized funds with strong expertise in one sector or segment, and unique strategy.
Very good. Well, that was sort of a terrific set of insights from both of you, Dominic and Agata. Thank you very much. Pleasure having you here today. And thank you for listening.